Thanks for watching this. I appreciate it and I know you're going to be glad you did. Now, I believe the IRS tries really hard to take the fun out of being successful. Would you agree? They do this by creating obstacles to get in the way of those who are successful. I'm sure you've experienced this firsthand. Because of these obstacles, I believe successful people like you deserve the opportunity to learn how the tax code, and that's key, the current U.S. tax code, permits them to get their assets positioned in such a way that when it's time to finally use their wealth later for retirement or whenever it's time to distribute the wealth, that they are completely exempt from both federal and state income taxes, regardless of their income level and regardless of the state they reside in. Could you imagine? Wouldn't that be awesome if it were possible? Well, it is, and this is what I do. How I do this is by understanding and demonstrating the tax code to you. What I do is make this possible for people. So I'm going to walk you through a simple notepad presentation. It won't take long. I'll flip over to my screen and you'll see a digital notepad for me to draw on. Now this conversation has three different phases. First, how much is it that you want to share with the IRS? Second, how much will you share with the IRS based upon your asset structure? And third, how do you get to tax exempt? So I'll break this down in detail on a notepad and show you how it all links and integrates together, which is really cool. So take the next 30 minutes or so and watch this video. It is a game changer, and I'm confident it will completely change your perspective on what you've been told in the past, regardless of how much money you have. So watch this video. I'll see you on my screen in about 2 seconds. Let me switch over here. Okay, so now we're on my computer. I want to make this as big as I can for you here. Now, I know attention spans are short, so stick with me. Okay, so I first want to ask you a question. I want to see where you sit. I want to draw this circle here, and this circle represents your wealth. It's like a pie. It represents both current and future wealth of yours, everything that you have. And at some point in time, you're going to use this wealth in order to fund retirement or distribute income from it, whatever it looks like for you in the future. Now, I'm going to hand you a knife, and I want you to cut out the slice that represents how much of this pie you want to share with the IRS. How big would you make that slice? I'm quite confident you said none of it. I wouldn't give them a crumb. I don't want to give them anything. I don't want to give them crap. Maybe you used a different four-letter word, but I'm sure it revolved around something like nothing. You don't want to give them anything. Well, that's really good. What you want is what I do. How I do this is by demonstrating how the tax code allows this to happen. And why I do it is because I believe that you deserve the opportunity to make that possible. Now, over the years, I've come up with an analogy that really, I believe, summarizes the financial journey of everybody perfectly, and it's climbing a mountain. Now, there are three stages to climbing a mountain. You have the ascent, you've got the summit, and then you have the descent. Now, why does this tie in perfectly in the financial arena? Well, because on the ascent here, this is why we are accumulating. We have our accumulation phase. I want to put a little R here in the flag. We have our retirement. At some point in time, we turn the corner, right? And we start to use our money. We now have distribution. And at some point, we're not working as much. We're working less. Our money is now doing things for us. Now, the financial industry both starts and stops right here at accumulation. Do you remember that? I think it was ING a handful of years ago. It might have been Fidelity. I don't remember. But there was a commercial of people walking around Central Park with their big green number. What's your number? What's your number? Right? How much do you have to get? How much do you have to get up to here? Well, just like climbing a mountain. You can Google this, Mount Everest. For those people who die, 73% of them die in the descent phase on the way down. They're most dangerous part of the expedition begins when they turn around and they start to come back. Nobody's goal when they're climbing Mount Everest or even financially is just to get a big number, is just to summit. Because if you got up there, touched the summit, and you died, you essentially made your goal, right? The goal is to get up and get back down and live to tell about it. But just like in climbing a mountain, when we are preparing for this journey, we have to take with us the tools we need to get up in order to get back down. And you might not believe this, but in 11 years of doing this business, I have never one single time had somebody sit across from me that had a tax exempt distribution plan already in place. They already had the tools that they needed to make this possible. So distribution is far more complicated, largely because of taxes, because of Social Security, and because of distribution rates. And this is what I'm going to get into and how all this affects our ability to be tax exempt. Okay, so let's go back up to our circle here. There are three types of money within this pie. We have our accumulated money. This is money that we've already set aside, right? We're working, we're saving. This is real estate, business values, investments, whatever. We also have lifestyle money. This is money that we use in order to live, right? Vacations, cars. Now, the goal is at some point in time that this pile here is big enough in order to fund our lifestyle. And that's all well and great, but is that really happening? Just like 73% of the people who die on the way down in a Mount Everest expedition, when we have 2 out of 100 people that are distributing their wealth in such a way to where they are self-funded essentially and don't need other sources of assistance from the government, etc. I believe this is where most of these people, quote unquote, die as well financially. So the third type of money here is transferred money, and this is what I specialize in. And here's what I mean by transferred. It is defined as money you are losing unknowingly and unnecessarily. Now, I'm quite confident you're successful, you're diligent, and you are saying to yourself, well, I'm not losing money unknowingly and unnecessarily. Well, it's very easy to do when you're coming down the mountain. And let me give you 3 examples. First, you already mentioned to me that if you could, you would want all of this money tax exempt, that you would want to control the knife, all of it. Well, if you could be put into that position, if that were possible and it didn't happen for you, then that would be an unnecessary transfer of your wealth. You paid more taxes than was necessary. That's huge. Number 2 is Social Security. Let me ask you this one. Do you feel you're going to receive your Social Security benefits? Did you say something like, well, probably not, I doubt it, who knows, I'm not counting on it, I don't want to rely on it, if I do get it, whatever, probably not. Did you say anything like that? So what I want to make sure we're looking at is if we say something similar to that, we are admitting to basically a 100% tax. Because this is all funded with after-tax dollars. And we're promised it back. And then if we shrug our shoulders and say, well, I probably won't get it, we're admitting to 100% tax. We threw tea in the Boston Harbor for taxation without representation. We have essentially double taxation here with representation. We should be revolting over this. This is pathetic, but we all know that, right? These entitlement programs are completely messed up. So here's the key question. If you could get all of it 100%, would you? Would you take it? I'm sure you said yes. I mean, if you can, but most of us believe you have to have no income or very low income in order to make that possible. So if it were possible for you, but it didn't happen, that would be a big transfer of your wealth. The third is debt. So let's pretend, I want to give you a hypothetical example. Let's pretend for a moment that you need $50,000 and you do not have it anywhere in your circle of wealth up here. You've gone to the bank, you've been declined, and you don't have any friends or family that can help you, and you come to me and you say, Kelly, I need $50,000 very badly. Will you lend it to me? And I say yes. And I hand you a check. Now, what are the 2 things you're going to want to know about that loan? You're going to want to know the terms, and you're going to want to know the rate. Now, here's how the term works. I tell you, I say, hey, man, there are no terms. You are struggling. I don't want to hinder that. I don't want to burden you. Let's get you on your feet, and we'll determine the terms later. Not bad. But here's how the rate's going to work. At a future time, when I determine what my needs are, I'm going to calculate a rate then, and I'm going to make it retroactive to today to get back how much I want. How would you feel about that debt now? That loan is the worst possible loan. Terms that are unknown and rates that are unknown. That is a huge problem. I'm quite confident you wouldn't take that. But what I just described to a T, perfectly, is the primary financial vehicle used by most households today. What I just described perfectly is a 401k, an IRA, and a SEP IRA. Let me explain what I mean by that. Let's pretend for a minute that this is a 401k, and you've saved and saved, you've climbed, and you get up to the top of the mountain, and you have $1 million in this 401k. My first question to you, if you were to come to me and say, hey man, I've got $1 million in my 401k, my first question to you is going to be, well, how much of this million is yours? Do you know? Think about this over here. How much of it's yours? You don't know. You have no idea how much of this asset is yours because you have a partner in this whole thing and they're the ones who control the knife, not you. And that's the federal government. They have not taken their share yet. They haven't told you how much they want. And they have, unless you take it all out at once, which again, a lot of people would advise you not to do. But if you do that, you would know how much their share is. But if you decide you're going to begin distributing income from this year after year after year after year, you have no idea how much they get to take each and every year. We don't even know what next year means in the financial arena for distributions out of pre-tax qualified plan assets. This debt is the worst debt imaginable. It is unknown terms at an unknown rate. Therefore, nobody can plan. So here's what happens. You get to the top of the mountain, you decide you want to start coming down, and you ask us, you say to the financial guy, hey man, how much can I take out this year? And we're like, well, how much do you need? The client will often say, well, should I take out more this year because tax rates are going to be higher next year? Or should I take out less this year so I can take out more next year if tax rates happen to go down? Well, now what is the only answer? After the advisor helped accumulate, got you a big old number, what is the only answer they can give you? The only answer is the same one you had. I don't know. I don't know. How much do you want? You see, the financial world literally becomes a waiter. We just become a waiter at that point. We can say, well, how much do you want to fund your lifestyle? Okay, I'll put the order in for you. And then that happens next year, and then the next year, and then the next year. This idea that you're going to be in a lower tax bracket, how is that possible to determine if we have to try to assume and calculate 30 years of a distribution? It's impossible. We don't even know if you're going to be in a lower tax bracket a year two. We have no idea. So the debt that is associated, that ties in with this, is unknown, and you do not control the knife, not one bit. So what you just told me earlier, which I believe you did, when you said if you could, if it were up to you, you wouldn't give them a crumb of your pie if you had the knife and you controlled the slice that went to the IRS. But yet down here, individuals are handing the knife over. It's a major problem. Okay, so let's fast forward to where it is time to finally begin distributing money from our assets. Now you have only 4 opportunities of how you are structured from a tax standpoint. And these are different buckets. I want to refer to these as buckets. Bucket number 1 through 4. Now bucket number 1 here is the ordinary income tax bucket. Now accounts that fit into this, or income that fits into this, is income from any business or real estate or our 401ks or IRAs, etc. So we have finally made it. We have finally gotten to the top of the mountain, and we are beginning to use our assets in order to fund our lifestyle. Now, the very first mistake people make here is that they think they want retirement income, and you do not. You want retirement cash flow, and this is key. Cash flow is what is most important here. So let's take a look at the ordinary income, meaning we have built up money over time in these tools, and now we are going to begin to use them to fund our lifestyle. And let's just, for argument or for math, let's just say we're going to use $80,000 for income. Now, according to the tax code today, the highest that the IRS can collect on ordinary income is about 35 grand. Now keep in mind, when you distribute money out of this tool, you have to pay two entities, both the feds and the state, leaving us 45,000 of spendable income. That's it. Now, there's something else going on here that is fascinating to me and quite frustrating at the same time. If you show $80,000, then the IRS believes, our federal government believes, that you are wealthy beyond your wildest dreams and you do not deserve all of your Social Security, so they will tax 85% of that benefit, meaning they will take 85% of your Social Security benefit and they will add it on top and tax it again at the highest rates, ordinary income. Now think about that. You funded this benefit with after-tax dollars, and now they're going to say you don't deserve it, and they're going to tax it again at ordinary income for a second time. I have a major, major problem with that, as I'm sure you can see why. Because were you able to opt out of the tax along the way? Of course not. It's required for you to pay it. It's promised you're going to get it back, and then they tax it again. So I want to go back to that first question I had when we were looking at your circle. If you could get all of this, regardless of how much income you have, would you take it? And I'm sure you answered yes. So let's move over to the right here. This next bucket, oops, not an O. This next bucket is our capital gains bucket. Right? Now this is stocks, bonds, mutual funds that are not held within our 401k or IRAs, but also when we sell a business or when we sell real estate, right? Now, here's how capital gains works. If we were to take an $80,000 distribution from this, the very first thing the IRS wants to know is how much of this was our cost basis. And here's what cost basis means. You might be familiar with it, but for those who don't, let me just give a very quick description. Cost basis is what the IRS wants to know is how much, let's just pretend this was $1 million of an asset. How much of it was our contribution compared to how much of it was growth? So if we contributed $500,000 to this account and it grew to $1 million, then half of this would be a return of our basis, a return of what we contributed. So if we took 80 grand out, then half of it would be tax-free, right? We would not have to pay tax on it. This actually goes back on your Schedule D. It doesn't hit your 1040. So we would show $40,000 of taxable income instead of 80, like in bucket number 1. Now, when I got in the business, the capital gains rate was 12, then it went to 15, then it went to 20, then it went to 23.8 because there was a 3.8 net income surcharge added with Obamacare. His second State of the Union, he vowed to make it 28%. Fortunately, that never happened. But all this is, capital gains is just another, bucket that they can, another spigot that they can turn on or off as they wish. But for the most part, the industry uses about 20%. So of 40,000 of taxable capital gains income, 20% of that would be our tax bill, so about 8 grand, leaving us 32,000 of spendable plus what we had as our cost basis. Our tax bill was drastically lower and our spendable income was drastically higher, and that's the sales pitch. That's why capital gains is often referred to as the most advantageous tax in all of tax code. I would agree, but tax exempt is still better. True? Now, here is what really bugs me, is that 40,000 of taxable income, just 40, just over 3 grand a month. The IRS believes that you're no longer wealthy, but you still don't deserve all of your Social Security, and they will tax 50% of it. Unbelievable. So far, as we mentioned earlier, if you've got to have no income or low income in order to get it back, but yet you're the ones who funded it for all those people in the first place. Very frustrating. So let's move over to the right again. This is our tax-free bucket. There's only one product that exists that's in this arena, and that is municipal bonds, often referred to as muni bonds. And here's obviously the sales pitch for these. If you take an $80,000 distribution from a muni bond, then you get $80,000. It's tax-free. But here's the problem. this gets communicated on your 1040, so you're right back up to 85% of your Social Security being taxed. 85% of it. Now, oh, and you can be showing or you could have about an $800 a month Medicare payment. Crazy. So the very last is tax exempt. Let me define tax exempt first. If we were to take an $80,000 distribution from our tax exempt bucket, it is tax-free just like the muni bonds. You get 80 grand of spendable money. But there is no communication with the IRS, therefore nothing hits your 1040. So this 80 grand does not go on your tax return. You don't even have to file a tax return because of it, which means there's no means testing. This is means tested, means tested, means tested on your benefits. This is not. So 0% of your Social Security would be taxed. You could qualify for, or your Medicare would be about $100 a month because of it. You could even qualify for an EBT food stamp card, and of course, all the government cheese that exists with this same $80,000 distribution. Wealthy beyond your wildest dreams over here. Not wealthy, but still don't deserve it. Wealthy beyond your wildest dreams, same income distribution, and you get everything. You get all of your Social Security back. Now, what you said at the very beginning when we looked at your pie, and I said, how big of a slice do you want to cut? You said none. I don't want to cut any slice in that thing. Well, this is the only bucket that allows that to be possible. And let's look at the only two products that make up this bucket. Number one is a Roth. Now, a Roth IRA is seemingly great for a lot of people, but I'm quite confident you don't qualify for it. And isn't that interesting that the government is going to say, yes, this exists, but we're going to put an income limitation on it, so that those who are making money have to fill up these buckets over here. The government does a great job of getting money shoved into these tools. It's the primary strategy. So there's an income limit, meaning if you're at about $117,000, you begin to be phased out of the Roth IRA. Why is that? They're going to allow me to do 53 grand into a SEP IRA, but nothing into a Roth. Now, there's also contribution limits. As of now, it's like 5,500. So even if you do qualify, you can only do about just over 5 grand a year. Which means, of course, if you're distributing from this thing and coming down the mountain, you can't get much money into this thing in the first place. So the distribution won't last very long. So you might be tax exempt for a bit, but you're going to roll right back into this. Thirdly, a distribution from a Roth generates a 1099. Now, I find that interesting. Why does it generate a 1099-R? I've asked CPAs that when I presented with them. They don't know, and it's not because, I do and they don't. It's because there's no answer. It's a tax-exempt distribution. It's tax-free, and Roth distributions are not means tested on your Social Security. But I believe the 1099-R being generated is because they're going to dump it eventually into this bucket. They would still promise them and still maintain a tax-free distribution, but if you happen to be blessed enough to have money into one of these, then you, quote-unquote, don't deserve all of your Social Security just like these other people. I'm extremely confident that's what's going to happen. So the only other product that exists in the entire tax code, in the 46,000 pages of tax code, the 26 feet of bookshelf space, is overfunded life insurance. Overfunded life insurance. Are you familiar with that? Have you heard of that? I know you've heard of life insurance, but overfunded. What's interesting about this really is who owns this. Only 4% of all insurance is actually overfunded, and banks make up almost that entire 4%. They own more of this than any entity on the planet. As a matter of fact, Bank of America has about $23 billion in this right now. Wells Fargo, 19. JP Morgan Chase, about 21 billion. Their holdings go up every single year. You can go to FDIC.gov. It's line 41 of their assets and liabilities. And they refer to this as their Tier 1 capital. All right. Next, politicians. You see, our politicians have to also follow our tax code. They don't have their own tax code. They have to follow the tax code as well. I have a colleague who worked with a current sitting senator who is overfunding his overfunded life insurance to the tune of $500,000 a year. Now, no insurance contract costs him $500,000. He's overfunding it to the tune of $500,000 per year. Now, he can't do that into a Roth, he can't do that into an IRA, right? But he can do it into his insurance. Our politicians, this is historical. Ted Kennedy, when he died, left $275 million of life insurance. None of it was term. And then the third is the wealthiest Americans. My biggest client does $2 million a year into their overfunded insurance. History is riddled with wealthy people using insurance. Now, what do banks, politicians, and the wealthiest know how to do with their money? They know how to shield it from taxes, and they know how to shield it from other people having control. So here's what we look to do. Keep in mind, let's keep this descent, this distribution, in the back of our heads here. What we want to do is we want these assets to create a huge rate of return. Go out there and kick butt. Go out there and earn a bunch of money. But we have to have this tool in place, just like the mountaineer has to have the tools they need to get down the mountain. We have to have this in place, not when we get here, but somewhere along the accumulation side. Now, I have a client right now who has a $420,000 a year cash flow out of his insurance bucket. He gets 100% of all of his Social Security. He qualifies for a food stamp card in his state. He doesn't take that. He feels that's abuse. But his Medicare is $100 a month. He takes this, and he certainly takes this. I want to explain that one here in just a minute, how we use the sale of his business and commercial property in order to fill this bucket up for him. So this is where he distributed his money from. So let's look at how that works actually. Let's draw these buckets again. And a teeter-totter. The three buckets are over here. Our overfunded insurance is over here. Now again, I would advise that we go out and you get as big of a return as you possibly can. But what we want to do is we might take some of your old money, which is your current accumulated value. We might direct it, a little bit of it, into the overfunded insurance to establish the bucket. We might take some of your new money, which is your contributions that you're funneling into these, and redirect as well, just for a short period of time, maybe a couple years, in order to establish this bucket. Because eventually when we turn the corner, when we start coming down the mountain, we want money here, and money here, and money here. Because based upon the tax implications of any given year, we can pull money from this, and none of this, if that is what is the most favorable. Or we can do some from here and more from here, or none from here and all from here. But we've got the ability to ensure, number one, we are never in a position to trigger a tax on the income. And number two, we are never in a position to trigger a means testing on our Social Security. We are balanced. So do we always withdraw money from this side? No. But we are at least in a position to where we can navigate it down. So here's exactly how my client did it that has a $420,000 lifestyle of spendable income and 100% of their Social Security. He had his commercial, he was a surgeon, had his commercial building, and he had his practice. And he knew in about 7 years, one of his junior doctors was going to buy both. That was his primary retirement strategy. He didn't want to maintain the building. He just wanted to be done, wanted to cash out. And we put $1 million for 2 years into this bucket. And then we stopped. So year 3, 4, 5, 6, and 7, we stopped. Well, that left a void of $5 million. When he sold the building and the practice, he paid his capital gains once and then was able to take the rest of that and fill this back up. So now he had about 7 million in here. He had some money left over in his 401ks and IRAs. He had some money left over, certainly from the sale of the building in his practice. And he had some, he didn't use any muni bonds, but he had money basically sitting in these two. This gets him in a position to have a $420,000 distribution. So if we never touch these, he's at 420. But we can still pull out if we want, like say 20 grand of his IRA. That won't trigger the tax and it won't means test him. If we need to pull more from these because tax rates are totally favorable, we can. But we will be in a position to get 100% of his Social Security, his Medicare for $100, and he can qualify for food stamps. All we did was balance him out. So when we look at the pie, when I asked you how big of a slice, you said none of it. I don't want to give him crap. I don't have to get all of your money over here to make that possible. I just need to get some of it in order to be balanced like this guy. And that's what I do. So this is the concept. And I want to emphasize it is the tax code, not the product. Not the product. Who cares what they call it if it accomplishes what you said you wanted? It's the tax code that affords us all these benefits and gives us the privilege of building wealth in such a way where our retirement distribution is completely exempt from both federal and state income taxes, regardless of our income level and regardless of the state that you reside in. Now, the product is just the funding mechanism for maximizing the efficiency of the code. Again, who cares what they call it? So look, if you've made it this far, I appreciate it very much. You've been with me for some time now, and there's a reason you stayed for the entire presentation. And if you found it valuable, then I would ask one of two things. First, I would ask that for anybody you have influence with, anybody that would watch this purely because you told them to watch it, that you ask them to do so, right? It's just that one person. And then second, I'd like to discover with you and determine how big of a bucket, number 4 over here, do we need to build for you according to what you want to do. It's all according to what you want to do. You tell me how much is in each of these buckets and how much you want in the fourth, or how much you need in order to make something like this happen, and we'll attempt to design it for you. We'll see what you're able to accomplish with this and how much tax-exempt income you can truly create. Now, over the last, 30, 40 minutes or so, I have definitely shared a ton of information like drinking from a fire hose with you. But as you know, information alone is not going to save you. You need expertise, you need strategy, and most importantly, you need action. Nothing happens without action. The system that I've created, the way I work, is not a fee-based system. I refuse to charge for my time and or my advice. I've been advised by others over and over that I should do so, but I utterly refuse to do it. So there's no skin off your nose except one more call. I'm sure you have questions, and that's why I make my personal calendar available to you. You can click on the button and get direct access to my calendar's availability and schedule some time. You will speak with me directly. And if it turns out that my calendar is just too full and what I have open doesn't work for you, then I'll have my business partner or my right-hand man, a junior associate, speak with you initially. He knows his stuff, but I personally will track you down. Our job is 100% to simply demonstrate to you what's possible, accomplish for you what you claimed at the beginning that you wanted, which was to be the one in control of the knife, and then to help you facilitate that plan being put into action. So look, you can find me all over the place. I want to drag this over here. You can check out my LinkedIn profile. If you type in Kelly O'Connor, it's a picture of me here. My Instagram, I'm building. Kelly D. O'Connor is my Instagram. I like posting stuff. My Twitter, same thing. I'm Kelly, at Kelly D. O'Connor. Looks like that. My YouTube page, you can type in Kelly D. O'Connor. I've got tons of videos to watch, and check it out. I'm going viral. I've got what? Or look, let's see. I'm at 101,000. Oh my gosh, I am so viral. It's crazy. Now you're going to notice on this link, though, I just want to say I've got this. It says Mountain Financial up here. That was my old company. We got acquired. I made the mistake of creating the custom URL, and I didn't know you could only do it one time. So according to YouTube, I can't change it, but I don't care. I'm still posting stuff, so you can always find me. One thing you won't find And that's a comment anywhere that I was out to scam someone for one silly insurance policy. I'll never risk my license for a deal ever. I love what I do and I take great pride in my expertise and my service and my staff. So at this point, we're done. Click on that button and schedule your call with me. You just have to like the IRS a little bit less than you like talking to me. So get on my calendar. Thanks again. I hope to talk to you soon.